Unknown ways to sell a business tax-free. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. And on today's Adam Talks, 2 ways that you probably don't know of that you can actually sell your business tax-free if it's structured correctly. So the first 2 scenarios, of course, involve retirement accounts and clearly involve, you guessed it, Roth IRAs, since they are the only type of retirement account, whether it's an IRA or 401k, so long as it's Roth, where you could potentially shelter all income gains from tax. Now, 2 requirements to do so. You need to be over the age of 59 and a half, and the Roth must be opened at least 5 years. So long as you're over 59 and a half, and the Roth has been opened at least 5 years, then that Roth has matured, and then any income or gains from that Roth IRA investment can be taken out of that Roth tax-free. So then when you look at the Roth IRA on one side, and then on the other side, consider a way to structure a business transaction where you can generate capital gain sale of stock or LLC interests, put them together, brain starts moving in different directions, different machinations, and hey, I got 2 scenarios for you. So the first scenario is where your IRA essentially, and you will own less than 50% of the business. And the second scenario is where you're going to need to own more than 50% of the business. Now, why is that 50% threshold so important? Well, under 4975 of the IRS tax code, that is a section that addresses prohibited transactions. And in a nutshell, 4975C says that if you invest your IRA, Roth IRA in an investment, you can't invest in a disqualified person. And a disqualified person is essentially the IRA owner, their lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, any entities controlled by such persons. Now, control means 50%. Now, there are scenarios where even if you own less than 50%, you could potentially trigger a self-dealing conflict of interest transaction under the prohibited transaction rules, but those are more difficult to attack because they're based off facts and circumstances. So in the majority of instances, so long as you're under 50%, combine your IRA and you or any disqualified person, and you can show that you're making the investment to benefit the IRA and not yourself personally, the transaction should be respected. So here's a couple scenarios. You own 30%, 20%, 40%. When I say you, I mean you, your lineal descendants, and your IRA in the aggregate, because there's attribution. If you own 40%, your IRA was 30%, now you're above that 50% threshold, and technically that entity is disqualified. So earning a salary or running your business could be problematic. So the first scenario is where your Roth IRA or Roth 401k owns less than 50% of the business. Let's say it owns 30%. You own maybe 15%. So you're under that 50% threshold. And then the other partners are not related to you, not lineal descendants. Could be brothers, sisters, aunts, uncles, cousins, friends, neighbors. Those are all fine. Those are not lineal descendants. So siblings, cousins, stepchildren, step-parent, those are all good. The only folks that you can't transact with in order to hinder your ability to address that 50% with attribution is you can't. Well, another way of looking at it is if you invest with yourself, parents, children, spouse, daughter-in-law, son-in-law, and your retirement account, that's all attributed and added together. So again, you own 30, 20, 10, 48% in the aggregate with you and your IRA, and then the other partners are non-related. And let's say we'll use 2 scenarios. It's a corporation, a C Corp. Someone comes and buys the stock from you after hopefully a lot of growth. The gains from the sale of the stock is a capital gain transaction, and that would go to the Roth IRA without tax. Obviously, your portion may be subject to tax, although you may be able to use a different exception. For example, a qualified small business company could get an exemption from that sale. I've done a podcast on that several months back. So you can check that out on the rules to employ. If you have a corporation open at least 5 years, under 50 million in gross receipts, you potentially can shelter some of that income personally. But if you have it in a Roth IRA, irrespective of how long or the company's been opened, capital gains transaction So long as you're over 59 and a half, the Roth's been open 5 years, you can then pull the money out tax-free. But even if you're 45 years old, 35 years old, the money will still go to the Roth IRA tax-free, and then you can reinvest in other types of investments. So that first scenario is your Roth IRA owns, and you or other lineal descendants in the aggregate own less than 50% of the entity, so you don't trigger the prohibited transaction rules. And this way you can still earn a salary. You can run your business as any other business because you're under that 50% threshold. Couple of things to keep in mind. Now, obviously, this works best when you start the business and your Roth IRA invests at the outset. Why? Because, from a valuation standpoint, it's obviously going to be much more beneficial for your Roth IRA to buy in at a low valuation. Now, that doesn't mean to say that, let's say your company's been in existence 7 months, 18 months, the value is still relatively low. It's still not operational. It's off the ground. It's a software development company. Maybe there's no tangible value, no goodwill, no hard assets. It's just kind of a concept. You still have more time. But if you have, a restaurant and you have done already $600,000 in revenues in your first 6 months, it's going to be hard to argue that stock's worth, $1. You may be able to, depending on what kind of valuation you get, but it's much easier to start at the outset with your Roth IRA coming in as an initial investor in order to secure a very low value. One other thing to remember is if your Roth IRA invests in a pass-through entity like an LLC, there could be a UBIT, unrelated business income tax, that applies to the business income generated each year. Anything over $1,000 could be subject to up to a 37% UBIT tax that your retirement account would pay. It only applies to retirement accounts, doesn't apply to individuals. So something to keep in mind. But if you did sell the stock, that would be a capital gain. You would be able to escape taxation, assuming there's no debt in the business. You'd be able to escape taxation and all the gains would go to the Roth. However, if it's a C Corp, because it's a box and there's a corporate level tax, there's no UBIT, and a sale of stock would also be tax-free to the Roth IRA, irrespective of debt or any business income, since there wouldn't be UBIT in a corporation. So that's the first way to shelter gains from the sale of a business if you own less than 50%. If you're in a scenario where you're going to own more than 50% of the business, you need a salary, you're going to own more than 50%. The way to shelter your gains is something called a ROB, so Rollover Business Startup Solution. I wrote a book on it several years back, it's an exception to the prohibited transaction rules under 4975C because it takes advantage of an exception under 4975D13 that allows a 401k, not an IRA, but a 401k to buy stock in its adopting employer. So let's say, company Nuco is going to be, let's say, it's going to open a shoe store, and you're going to want to control it. You're going to put all the money in. Let's say you're going to own, 90%. You get some other investors, maybe. You're going to have some employees, but you're going to run the business. You want a salary. I mean, this is your thing. This is your full-time gig. The Roth IRA scenario one won't work because you're going to be above the 50% and you want to be actively involved. That would trigger the prohibited transactions. Now, if you owned over 50%, but you didn't care about earning a salary, then the Roth IRA could work. You just need to be passive and essentially removed from the day-to-day operations of the business. But scenario two addresses the position where you're going to be actively involved, earn a salary. How does that work? The way it works is a corporation set up, say it's a NewCo, can't be an LLC, it has to be a C Corp. And then the NewCo, will establish a 401k plan. The NewCo will establish a 401k plan, not an IRA. It has to be a 401k in order to take advantage of the exception under 4975D13. So let's say you have $200,000 in a Fidelity IRA. You'll roll it over to the new 401k. The 401k will buy stock in the company, let's say for 90%. 10% will come from whatever, your dad, your mom, brother, sister, cousin, whatever, you. So now the company's owned 100%, 90% by the 401k, 10% by other investors. That money goes from the 401k to the corp. In return, the 401k gets 90% of the stock. The other investors get 10%. Let's say you're the president, you become an employee. And if you have other employees, you offer the 401k to the employees, which is a great thing. But what you've done now is you've been able to use the $200,000 of retirement money without taking tax or a 10% early distribution penalty, using it to invest in a business that you control and earn a salary from. Remember, you're over 50%. That's why you're going to need to use the ROBs, the 401k corp structure versus the Roth IRA LLC, Roth IRA Corp, because of that 50% threshold will be breached. And now you run your business, and let's say after a couple of years, someone comes along and wants to buy it, they can buy the stock from the 401k tax-free. All the gains would go to the Roth 401k tax-free. What happens if they bought the assets? There'd be a 21% corporate tax, and then the retained earnings would be dividended up tax-free to the 401k, at least 90% of them based off my example, and 10% would go to the other investors that would pay income tax on that dividend. So by employing these two strategies, whether you own less than 50%, scenario one, or you're going to own more than 50% and be active, scenario two, you can technically do scenario one if you're going to own more than 50% but not be active, right? Let's say you're going to own 99%, but your brother's going to run the whole business, but you just want the profits. You got some cash lying around in your IRA, you're going to co-invest. Technically, you can do scenario one, you just can't be involved in the business, earn a salary, basically be active. If you want to be active, earn a salary especially, you got to go to scenario two if you're going to own more than the 50%. And that scenario, you'll need to do the ROBs, which involves the corp and the 401k. What's the downside of the ROBs? I guess you need to use a corp, which isn't that problematic. It's just a 21% corporate tax. I guess the other downside, if you consider it a downside, is you have to offer 401k benefits to your employees, which I personally think is a good thing, especially now that the Secure Act 2.0 offers up to a $5,000 credit over the next 3 years for setting up a 401k, plus up to $1,000 per non-highly compensated employee credit for each employer contribution. So government's basically paying you to set up a 401k. So this is an amazing time to do a ROBs and offer 401k benefits to your employees and yourself, obviously. And also use your money tax-free, penalty-free to fund a new business, which is the American way. It's the American dream. That's the beauty of America, that you literally can have lunch, dinner with a buddy, or even a spouse, right? And literally on a napkin, devise a business, go set up a corporation and start your business in a week, and you're off to the races. Where if you live in Europe or China, that just doesn't happen. And that's why I believe in the future success of America. No matter what you say about China, their work ethic, the communist structure, or any other country in the world, they just don't have the freedom of thinking and the ability to where our government is certainly pro-growth and pro-capitalistic. So you combine freedom, democracy, capitalism, it's going to beat any other system in the world. That's just the bottom line. So I'm super bullish on America, and I think thousands of Americans, or hundreds of thousands, I should say, start businesses each year, more than that. And looking at either a Roth IRA or a ROBs, could be a really good strategy, especially if you're considering it before kind of the company has a lot of value, because you can generate tax-free capital gains growth, which, trust me, when you're a business owner and you're looking to potentially have an exit, the sheltering of the gains is something any business owner thinks about. And the key is just kind of doing it at the outset. It's much harder to do it after your business has been operational for many years, because you're going to need a lot of money in your IRA or convert a lot of money to Roth to buy enough shares to make it worth your while. Like, I spoke to someone maybe a couple of days ago, and she had a really good business, like 15 employees, good value. And, she heard one of my videos or podcasts on kind of this topic, and she spoke to someone on my team, and then they passed her to me, and I was talking to her, and she's like, I want to do it. And I'm like, honestly, it doesn't make sense. How much money do you have in your IRA? She's like, I got like 300K. I'm like, what do you think your business is worth? She's like, probably 2 to 3 million. I'm like, you're going to buy 10% of your business? What's the point? It's not worth it. Like, don't even waste your time. Right? She's like, you're right. If I did this 2.5 years ago, my business was probably worth like 300 grand. I could have literally bought the whole business in the Roth, and then I would have done either the ROBs, or if I wasn't active, maybe have someone else run it. I could have the Roth IRA own all of it. shelter all the gains. But c'est la vie. You got planning is key. It's just the way it is. Unfortunately, we don't all think about this stuff, but hey, that's why I'm doing these podcasts. That's why I'm doing the videos, is to educate people. So you are knowledgeable before you kind of start your business. It's the Peter Thiel way. He was able to do it with PayPal when it was, pennies on the dollar. But if he did it when PayPal was already public and worth billions of dollars, like the Roth IRA strategy went to work because he wouldn't have had enough money in his Roth to own a significant amount of those shares. So planning, education. That's what it's all about. That's hopefully if I can just impact. Hopefully, I can impact hundreds of thousands of people a week. But even if it's just a couple a day, it's worthwhile to me, and that's why I love doing this stuff. It works. It's based off the code. It's based off mathematics, deferral, tax-free growth. It's the eighth wonder of the world. You don't trust me? Albert Einstein said it. Compounding returns is the eighth wonder of the world, and the Roth IRA is really the best, or Roth 401k is essentially the best vehicle to take advantage of that strategy. So thank you so much for listening. If you're watching on YouTube, appreciate. Don't forget to subscribe. If you have a comment, question, leave it. I'd love to hear from you. It's what I look forward to. I promise I'll get back to you guys super fast. So that's it. Otherwise, have an amazing rest of your week. Hope your summer's going great. Take care, and I'll see everyone again next week. Thanks for hanging out. Take care.